Hi, my name's Tim Doyle, Director of Evans Doyle and Cryptocurrency Tax. In this video, we're going to be talking about 2023 Provisional Tax. And there's one thing that I really want to emphasise to everyone watching. If you haven't made a profit in the 2023 year and you don't expect to, there's no need to pay 2023 Provisional Tax. At the moment, we're sending out tax letters to all of our clients for tax to pay on the 28th of August 2022 for the 2023 financial year. But if you haven't made a profit or you don't expect to, there's no need to pay that tax. With that said, in this video, we're going to cover what is provisional tax and give you a basic understanding of concepts around cryptocurrency, and then we're going to talk about what to do and how you can make an informed decision for this 2023 tax. So with that in mind, let's get into it. The first thing that I want to mention is about realised gains. And the important formula to remember here is that profit equals our sale value, what we sell it for, minus our purchase value. You'll have to excuse my messy handwriting. So this, firstly, a disposal occurs when we trade cryptocurrency for another token, or we sell it to fiat, or we dispose of that token. That could include putting it into a liquidity pool or using it as margin trading or something like that. And you'll see that there needs to be a sale for us to have a profit. If you don't sell, there's no profit. So if we're going to be using this graph a little bit here, so if this is time and this is money, if you buy cryptocurrency here and the market goes like this, or the market goes like this, or the market goes down, there's no need to pay tax on any of these market movements until you ultimately sell the token. So if you sell it here, the difference between the purchase price and the sale value would be taxable income or profit. Likewise, if you sold it down here, this would be a loss to claim. So it's what we're talking about here is a concept of realised gains or crystallising the gain. And the key thing for you to remember is that the profit only occurs when you sell. The next part that I'm just going to talk about, just get rid of that for now, is the financial years. And this is really important because we're talking about how one prior financial year affects the next financial year. So bear with me while I draw these up. But the 2021 financial year is from the 1st of April 2020 to the 31st of March 2021. The 2022 financial year is from the 1st of April 21 to the 31st of March 22. And the 2023 financial year is from the 1st of April 22. I'm pretty sure you get the picture by now. So 21 financial year, 22 financial year, 23 financial year. So when I'm talking about 2023 provisional tax, we're talking about this financial year here, 2023 year. And at the moment, we're currently in July. So we're not even partway through it yet. There's still a long way to go. And if the crypto markets have taught me anything in the last 5 years, anything can happen. So just important to lay down those concepts to understand on them as we build on them going forward. So we're now going to talk about what is provisional tax. And this is when IRD take this prior year, they either take the 2022 year and they add 10% to it, or they take the 2021 year and they add 5% to it. And what I mean by that is they expect you to make the same profit as 2022 plus another 10%. And that would be your 23 provisional tax liability. Now, only if your 2022 tax return is not filed, they take the 2021 year plus, that's the other way around. That one plus 10% or that one plus 5%. So you can't choose, it's to do with the filing of your tax return. So sometimes we can be strategic in the filing dates of your tax return. So this is placed off plus 10%, or sometimes this will be calculated based off 5%. So with most businesses, their profit is quite easily predictable. It's the same year on year plus small amounts for growth. So for most taxpayers outside of cryptocurrency markets, this provisional tax system actually works quite well because it's consistent, it's predictable, and it enables flow and planning and preparation. However, with crypto markets all over the place, it's like a square peg trying to fit into a round hole. It doesn't quite work. In the 2022 year, we've had massive profits, triggering massive tax bills. But then in the 2023 year to date, we've seen massive losses. So as I emphasised right at the start, if this year was 31 March 22, you might have made a significant profit for this 2022 financial year. But for 2023, you might have made a loss. And if you've made a loss, there's no need to pay the 2023 provisional tax. But unfortunately, anything tax, it's not quite that simple because we're only at the 31st of July. So let's dive into this 2023 situation in a little bit more detail. And let's say that we started the year up here, and this is our cost value or our purchase value, which is important because it's this value here. And we know that markets have gone down. And this is where we are here at the 31st of July 22. So, as it stands, year-to-date position is a loss. And therefore, we need to think about what will happen next in the markets, because we don't know. Is the market going to stay flat? Is the market going to go down further? Is the market going to recover so that it's in line with our cost value? Or is the market going to increase above our cost value up to here? So if we're here, and this is your cost value, this is the market, so you're in the red, you've made a loss. If you're in this situation here, or this situation here, if this is your expectation right up until the 31st of March 23, there's no need for you to worry about your 2023 provisional tax, because even if you sold here, the sale value is the same as your cost value, and you're going to have a $0 profit. It's only if you're going to make a profit that you need to pay the provisional tax, or you need to even consider paying the provisional tax. So it's only if you expect to make a profit above your cost price that you need to pay the provisional tax. And like we talked about at the start, it's only if you sell up here. If the market goes up and you don't sell, well, you haven't crystallized or realized that gain, so there's nothing to do for tax purposes. So be strategic around it. If you don't need to sell, don't sell, because then there's no tax to pay. So hopefully this is all making sense to you. Let's just talk about a couple of other options while we're here. The first one, let's just say you don't know. So say you've got some cash in the bank and you want to be conservative. So put on my conservative account hat and we say, look, I don't expect to make a profit, but I've got this cash, I'm going to hedge my bets, so I might as well pay the tax anyway. And the result for and remember, you're paying that tax based on a prior year plus a percentage, which isn't likely in the crypto markets so far. So I pay this tax to the IRD, and I pay too much, and I didn't need to. So in that situation, I'd get it refunded back to me. But there's no need to sell the crypto at a loss to pay the tax when you clearly know that you're in a loss-making position. In the other example, say we get to this point, you haven't paid the provisional tax, and you end up at this point where you've made a profit and you should have. We're now going to cover that option. But the worst case scenario is that your exposure is about 6 or 7% interest to the IRD. In that situation, what we'd do is we'd use tax pooling, and we'd buy backdated tax at an effective date of the 20th of August. So IRD receives your tax money as if you had paid it on time, even if you pay it at a later date. And that's where that interest cost comes in. So whatever your tax bill is going to be, add 7% to it. And if you end up in this option, when you do make a profit, that's your exposure. The final situation we're going to talk about is what happens if you have made a profit for the year to date. And I don't expect this will apply to many people or many clients. However, we do have some very smart clients who can short the market or have received ICO token distributions that they've since acquired extremely cheap and sold at a profit even in this market, or same with NFTs, or same with NFT mints, or just bought crypto really cheaply and still have a really low cost value. So the market value is still miles above their average cost price. So this last situation will only apply to, I think, a very small amount of taxpayers just on what's happened with the market. So let's say that this was the value on 31st of March 22, and this is the value now. So therefore they're on a year-to-date profit. They've made the profit. And again, same principles, there's realised that profit. So let's just say that their year-to-date profit is 100 grand. And we know, in this example, let's just say that the 2022 profit was 300 grand. And we know that on the first provisional tax instalment date, the 28th of August, they need to pay a third of their tax for this plus 5%, and then you pay it in 3 instalments, the 28th of August being the first one. So if that's you, we know that the profit here is 1/3 of the 2022 profit. So they're on track to make the same profit as last year. So if you're in that position, we'd actually suggest that you do pay the provisional tax to IRD based on last year plus 5%, because that's how you're tracking. Of course, if you don't want to, in this situation, I'd suggest that you do pay the provisional tax because you've made the profit. However, I do understand that some of our clients are quite aggressive and risky when it comes to the crypto markets. So I'm not going to dive into that deeper. There are extreme risks associated with this method, but if you were going to delay the provisional tax, the same theory or principles apply, that you'll be exposed to use of money interest and late payment penalties if you have a provisional tax obligation and you don't pay it and you end up having a 2023 profit. So in this situation here, because this provisional tax on the 28th of August is 1/3, here the year-to-date profit is 1/3. Therefore, my advice would be to pay the tax. The other option that you might be in is that the year-to-date profit could be, say, only 50 grand. So therefore, we know that this is 1/6 of the 300k of the last year profit, or it's half of what we were at this time last year for the first instalment. So therefore, if that was you in this situation, I'd pay tax at your marginal tax rate, likely to be 33 or 39%. If you're in this situation, feel free to give us a call. So that's all I've got for you today. My emphasis again is if you've made a loss or you're going to make a loss for the 2023 financial year, there's no need for you to pay the tax. The difficulty from our end is, firstly, we don't know when you're going to sell, and the sale is the event that triggers the profit. And secondly, we don't know what the price is going to be when you do sell. And that's what makes it difficult for us to give you advice. But hopefully today we've given you a few things to think about. If you're a client of ours and got any questions at all, please let William or I know. We're more than happy to go through your specific situation with you. Thanks for watching.